At 2:07 a.m. New York time, while most screens were dark, a metal dam gate quietly opened. Not water, silver. Roughly 1660 tons, pushed into the global bloodstream like an emergency transfusion. The price didn't just move, it flinched, the way a market does when it realizes the hand on the lever isn't a hedge fund, it's a state. So ask the obvious question, why now? And the harder one, why reverse course right after? Stop scrolling and listen, because if you're waiting for a safe dip, you may be standing exactly where the flood is headed. To understand why this move mattered, we first need to clarify what silver really is in today's economy. Silver is not just a precious metal stored in vaults. It is a hybrid asset, part money, part industrial input. Unlike gold, more than 50% of global silver demand comes from industry. Solar panels, electronics, medical devices, and emerging energy technologies. When headlines say a country dumps silver, it doesn't mean retail investors panicked. It usually means state linked entities release strategic inventories. Metal that was accumulated quietly over years when prices were low and liquidity was abundant. Historically, silver has always been volatile precisely because of this dual role. In 1980, it was squeezed as money. In 2011, it spiked as both inflation hedge and industrial hedge. And since 2021, the market has lived with a structural contradiction. Official prices looked stable, while physical availability tightened behind the scenes. From 2021 to 2024, global silver markets ran persistent deficits as industrial demand outpaced mine supply. New mines take 10 to 15 years to develop. Recycling helps, but not fast enough. This created a fragile equilibrium. Prices controlled largely by paper contracts, while physical users quietly competed for real metal. Against that backdrop, a sudden release of hundreds of tons was not neutral. It was a policy action, timed, sized, and executed for a reason. And that reason becomes clearer when we ask a more uncomfortable question. Was this about silver supply? Or about financial stress elsewhere that needed fast liquidity? Because in modern markets, metals are not just resources. They are pressure valves. At the core of this decision sits a simple truth. Governments do not sell strategic assets unless liquidity matters more than optics. In periods of economic stress, inventories, oil, metals, grains become tools. They can be converted into cash without issuing new debt, without alarming bond markets, and without admitting weakness. Silver is particularly effective for this purpose. It is valuable, globally liquid, and, unlike gold, less politically sensitive. Releasing hundreds of tons into the market can raise billions in short order, while publicly framed as a normal adjustment. But liquidity operations rarely stop where they begin. Once metal enters the open market, it collides with a system dominated by derivatives, not physical exchange. Most silver does not trade hand to hand, it trades as futures contracts, swaps, and structured products. Refiners, manufacturers, and banks hedge exposure by selling paper silver against expected physical flows. Here's the trap. When volatility spikes, even downward margin requirements change overnight. A move of just $1 or $2 per ounce can force participants to post tens of millions in additional collateral. Those who cannot sell what they can, contracts, inventory, anything liquid. This creates a feedback loop: metal release, price shock, margin pressure, forced selling, more volatility. It doesn't matter whether the long-term fundamentals are strong. In the short term, cash flow dominates conviction. And this is where policy meets market mechanics. Silver's industrial side complicates everything. Solar panels, electronics, and power infrastructure still depend on it. But demand is cyclical, not linear. When construction slows, exports soften, or factories reduce utilization, inventories rise temporarily. In that window, stockpiled silver shifts from strategic to monetizable. But this relief is temporary. Industrial demand does not disappear, it pauses. When it returns, the same metal must be sourced again, often at higher prices. History shows this pattern repeatedly. Short-term oversupply narratives masking long-term structural tightness. Finally, there is the geopolitical layer. Commodity action sends signals without press conferences. A sudden release tells markets, inputs will remain available. A reversal tells insiders something else. The cost of intervention is rising. This is not contradiction, it is stress management. When the pressure eases, accumulation resumes. When it spikes, reserves move. Silver is not the story, it is the instrument. And the real question becomes unavoidable. If this much metal had to move to stabilize the system, how tight was it behind the curtain? To see the real impact, we need to zoom out. Silver is not consumed evenly across the world. Some economies produce and refine it, others import and depend on it. That imbalance is where consequences emerge. Industrial economies that rely heavily on advanced manufacturing, solar modules, electronics, energy infrastructure are especially exposed. A short-term drop in price may look like relief, but volatility is poison for planning. When procurement teams cannot lock prices, projects stall, timelines slip, costs get repriced higher later, not lower. Meanwhile, financial markets tell a different story. Exchange-traded products and futures react instantly, amplifying moves far beyond physical flows. Retail investors see price weakness and assume demand has collapsed. But manufacturers see something else: uncertainty, not abundance. This divergence matters. When paper markets suggest excess supply while physical users quietly rebuild inventories, stress accumulates invisibly. Globally, the consequences ripple outward. Input costs for energy transition technologies fluctuate. Capital expenditure decisions are delayed. Smaller manufacturers, unable to hedge effectively, absorb the shock first, often through layoffs or canceled expansion. At the macro level, commodity volatility feeds inflation expectations. Central banks watch it closely. Governments intervene discreetly. Each action layers complexity onto an already fragile system. And history is unforgiving here. Markets that suppress signals rarely eliminate pressure. They redistribute it over time, which leads to the uncomfortable conclusion: short-term stability achieved through intervention often comes at the cost of longer, sharper adjustments later. Periods of violent volatility are uncomfortable, but they are also revealing. They expose where systems are fragile and where value is misunderstood. For investors, the lesson is not to predict the next price tick, but to reframe risk. In markets where paper instruments dominate, resilience often comes from simplicity. Clearer position sizing, longer time horizons, and understanding the difference between price discovery and forced liquidation. Volatility does not destroy value. It redistributes it from the impatient to the prepared. For businesses, especially manufacturers, the strategy shifts towards supply security. Long-term contracts, diversified sourcing, and investment in recycling become competitive advantages. Companies that treat silver as a strategic input rather than a spot commodity are better positioned when demand inevitably rebounds. At the policy level, the challenge is harder. Strategic inventories can smooth shocks, but they cannot replace supply. New mines take a decade or more. Substitution has limits. Intervention buys time. But time is only useful if it is used to adapt. Looking forward, two scenarios emerge. In the short term, expect continued instability, sharp moves, misleading narratives, and reactive positioning. Markets will test confidence repeatedly. In the longer term, however, structural forces reassert themselves. Energy transition, electrification, and technological density all point in one direction: persistent industrial demand. When confidence returns and inventories thin, price will matter less than availability. History suggests that markets which survive suppression do not stay quiet forever. They reset violently. Those who understand this don't chase certainty. They prepare for inflection points. This was never just about silver. A 660-ton release was a signal of stress, of control, of a system trying to manage pressure without admitting it exists. Prices moved, narratives shifted, and attention drifted. But beneath the noise, the structure remained fragile. If there is one lesson to carry forward, it's this: markets don't break when prices fall. They break when confidence and liquidity collide. Don't let volatility blind you. Share this analysis, question simple explanations, and stay ahead of the story before it becomes obvious to everyone else. Because by the time the crowd feels safe again, the real move is usually already over.